Welcome to STRAT this week. Will Woodall, Mike Rarey. Week of June 12th. We're getting to almost at the start of summer here. And the rally in equities continues.
It does.
So today we're going to look at returns from last week briefly. But we're going to dive deeper into liquidity because there's a lot of information under the surface in the liquidity subsets that we want to dig into that really give us pause and make us question this little rally here. So let's start with the equity returns from last week.
Last week, the equity market gains were predominantly in value stocks, particularly small value. You see small value stocks thus far in June up over 7%, quite a rally. They had been beaten down earlier in the year, particularly in March. A lot of the regional, small and mid-sized regional banks, if you're going to find them anywhere, you're not really going to find them in large weights, but if they're anywhere, they're in small value. So definitely seeing a rebound there. And believe it or not, large growth lost money last week.
Wow.
Who'd have thunk? NVIDIA can't go up forever.
AI is dead.
No. So,
all right, let's. Fixed income wasn't so rosy last week.
yeah, really not a whole lot going on. Yields were pretty range bound. There is a very substantial short position within the hedge fund community at the front end of the yield curve.
Yeah.
So right around that 2-year yield period. And you know, the idea behind that short is that front end yields have to go up in order to get on board with or be consistent with the reality that the Fed is not cutting this year. And they're going to keep rates high for an extended period of time. So we'll see, obviously, with the Fed meeting this week, you know, we'll see how that trade works out.
Yeah, it should be interesting to not only see what the Fed says if they skip, but how the market reacts to whatever they do.
Right.
All right, and the alt space, good week for all the alts as well.
Yeah, green across the board for commodities and REITs. Doesn't really change the trends year to date. Global REITs have been underperforming U.S. large cap stocks, just like everything else. And commodities still down quite a bit year to date.
Great. So let's start our dive into liquidity with our standard framework slide here. It shows liquidity low and rising.
Yeah, and this obviously is our go-to liquidity slide. Liquidity is a factor in our framework that we know matters in terms of explaining economic growth, financial asset performance, etc. But there are multiple dimensions to liquidity. This is just money supply in the U.S. There's also broadening that out and looking at that globally. And then there's, of course, net liquidity. We look at all these different things. And, you know, it may seem like they're saying different things, but they're all starting to line up in one direction now. Mm-hmm. You know, within the U.S., this chart specifically, liquidity low and rising, that's usually a decent environment for equities. But we've never had liquidity this low,
right,
and rising from these levels.
Right.
Basically, that improvement, all it implies is we're going to have just as much money now as we will a year from now, roughly.
Yeah, this doesn't suggest the money supply in the U.S. is going to grow,
mm-hmm.
which we can sort of dig into a little deeper into how the money supply growth and equity returns correlate. So
yeah, definitely. So this is broadening out liquidity. So now we're looking at central bank assets from all basically the largest major developed market central banks. We have them listed on the bottom, but you know, think Bank of England, ECB, People's Bank of China, Swiss Bank, Bank of Australia, so on and so forth. And what you do is you combine all their assets and you translate them back into US dollars and you overlay the S&P 500.
Mm-hmm.
And what you find is, even though this is a global central bank asset figure, the R squared versus S&P 500 returns is 0.93. So this is once again reinforcing, hey, liquidity matters.
Yeah.
Right? And there are some detachments, but if you look at what's been going on here recently, you see the S&P 500 bottoming in October last year. You see that sort of out to the right of the chart. And then you see the central bank balance sheet index that we've constructed, you know, starting to go up a little bit. And, you know, you think, why is that happening? We just looked at the U.S. liquidity slide, and it was just straight down during that time period.
Right.
Basically, what happened here was, although central banks were not pivoting Nobody was cutting. Nobody was buying assets. Just the dollar was weakening. That was really it. And so when you take these central bank assets and you translate them back into dollars, there are more of them. So now that the dollar has weakened 10% since last October, that's pretty much done. And now we're back to the trends from 2022, primarily, early parts of 2022, where now you see central bank assets going down, and in a direct contradiction to what's happening with the S&P 500.
Yeah. So just to put it in simple terms, 93% of the S&P's return can be explained by
central bank assets. Yeah.
That's a pretty strong correlation, right? You don't find it much stronger than that.
Well, we certainly try.
The work we do in this industry, you don't really find correlations that high.
Right.
So you're saying that central bank assets are starting to diverge. How historically impactful is this gap currently?
Yeah, that gap. So we did that math for you all. So now we're just taking the difference between the S&P 500 level and that central bank balance sheet or central bank asset index. And you can see there are divergences. Right now, the S&P 500 is a little over 8% above fair value as implied by central bank assets. That may not seem like a lot, but that's actually a full standard deviation. That's pretty significant statistically. And what you see is most of the time when we get one standard deviation above fair value is this has to clear up. It can only clear up two ways. Either the S&P 500 goes down, comes back down to fair value, or central banks increase their assets. And none of the central banks that are in that balance sheet index, with the exception of China, are really planning on doing any easing. So the path of least resistance here is the S&P 500 would come down back towards fair value, and when it does, it typically overcorrects. So I think that's notable. The other thing that's notable
is you're saying like it could overcorrect to the downside here.
Yeah, definitely. So then you're looking at, as if it were to overcorrect one standard deviation down, then you're talking about almost 20% down from these current levels on the S&P 500.
And you can see periods where that has happened before.
Yeah, for sure.
Clearly.
Liquidity matters. It's not the only thing that matters, right? There are divergences here. You look at 2019, that was a huge divergence. It ultimately got rectified in a big way, right? It just took a long time.
Right.
But 2019, equity markets were just levitating. Central banks were just holding their balance sheets constant, and equities continued to grind higher. But we don't think that's the setup here, because now it's not that just central banks are holding their balance sheets constant. They're reducing them.
Right.
Direct contradiction to what's happening in equity markets.
Right.
Yeah.
And that's a big change for most investors, because you think about it, the last 20 plus years has been the opposite. So I don't think investors generally are used to this type of behavior.
Right. I mean, this light blue line, it just goes up.
Yeah.
Until 2022. Right?
Yep.
So
let's move on to net liquidity and talk about what that means. So just maybe as a primer, discuss the differences between what we just looked at and then what we're looking at here, net liquidity.
Yeah, and what we're doing, these different dimensions of liquidity, we're really coming down to a much narrower, timelier focus. This is sort of the narrowest focus and the timeliest, and that's net liquidity. And net liquidity, it takes your big money supply metrics or your big central bank asset metrics, and then it adjusts it for the amount of money that's actually in the economy. There are many different things that constitute money supply, but they're not all created equal in terms of ability to impact stock prices and economic growth. So you do some simple math here. You take Fed assets, which were part of what we just looked at, central bank assets, the biggest part. And then you subtract out reverse repo. So reverse repo, that's money, but it's literally not being used.
Right.
It's just being lent back to the Fed. So it's not out in the economy doing stuff. And then you subtract out the Treasury General account, which is similar. That's the Treasury's bank account at the Fed. It's not out in the economy. It's just sitting there at the Fed. It's just excess liquidity, if you will, that the Treasury doesn't need right now. So you do that math, and you get the green line. And why we say this is timelier is if you take the 2-week moving average, it gives you a 2-week lead on the S&P 500, a net liquidity implied fair value. And the other thing you can see here is since the market low last October, net liquidity has gone, it's been volatile, but it's actually higher than it was. Even though money supply is straight down, even though the Fed is reducing the size of their balance sheet, net liquidity is slightly higher because the Treasury during that time period was releasing liquidity into the economy. They were spending down the Treasury General Account. Right? That has limits. You can't, the Treasury can't go, well, Treasury technically can't go into margin on their Treasury General Account, but the Treasury lives in margin. So Correct. It's like, you know, but basically what we're saying here is the Treasury General Account, the most recent data is June 7th. It was drawn down to about 45 billion. That's an average daily figure over that week. And that's pretty much it. That was really the last metric before the debt ceiling bill got passed. And now the Treasury needs to rebuild the Treasury General Account. They usually build it up to about 500 billion. And that is tightening.
Or more potentially, right?
Yeah, that's tightening. On a net liquidity basis, that's tightening.
And so that's what drives this green line down?
Exactly. To, you know, an S&P, net liquidity implied fair value on the S&P at the end of September, you know, somewhere near 3,200. And that's not a super precise number, but directionally is what's important, right? Is we're at the near-term peak in net liquidity. And unless the Fed totally pivots and starts buying assets again, it's just going to be heading down from here. And in terms of when, well, the data's through June 7th. You take a 2-week average and it leads by 2 weeks. So we're talking 2 to 4 weeks. Over the next 2 to 4 weeks, this will turn from a positive to a negative on the S&P 500.
And what is the historical correlation between these numbers?
Yeah, this is like something like 0.9.
0.9.
So
still very high.
Yeah, that's why we look at it in multiple dimensions, right? But they're all sort of lining up to say the same thing. Then there was a little breather here in terms of liquidity going from being really bad to just meh, which is a technical term. But now it's going to go back to being really bad unless the Fed and other central banks pivot, and they're not going to do that.
Right. And this gap doesn't last long. It usually closes.
Yeah. The last time we had a gap anywhere near this was last summer. That summer bear market rally, which, you know, we're right back at those levels. We're retesting those highs from last summer, even though that liquidity support is going to be worse.
The liquidity was here.
Right.
Then. Now we're looking at it down here.
Yeah.
So should be an interesting summer, starting in a few days. So let's move on. Not much additional updates to the framework. Inflation first.
Yeah. So we're getting the CPI prints this week. The Fed will have that data going into their monetary policy decision. What's that likely to show? If you look at headline inflation, this reading and next month are going to show a big deceleration, a big disinflation, because the huge rally in commodities from about a year ago are going to fall out of the year-over-year comparison. So just base effects. So if you see headline inflation come down a lot over the next 2 months, everybody's expecting that.
Right.
All right. It needs to come down more than people are expecting. And then core CPI, which doesn't have food and energy, it's not going to show significant deceleration over the next couple months. It's really sort of going sideways. So it'll be interesting. The big thing to focus on with the CPI readings will be core X housing, core services X housing. That's what the Fed, super core. That's what the Fed will be looking at. I'm sure we'll report on that next week probably.
Yeah, we should probably add it to this chart.
Yeah.
All right, on the economic growth front, not much of a change here either.
Yeah, very similar picture. You know, Atlanta Fed GDP now is still tracking on the high side. Economic surprise indices thus far are tracking on the high side, where basically every sort of subset of economic data point is generally positively surprising, with the exception of survey-based data. That's why this is called sort of the vibe session, is something that's being thrown around. So, we'll see how this shakes out. If we get something like 2.2, which is what Atlanta Fed GDP now is saying, then these numbers will come up, but just a little bit, and any growth this quarter will probably get taken from expectations for future quarters.
Future quarters, yeah. Yeah, I'd be shocked if we got 2.2 anything.
Yeah.
This stage, okay. Initial jobless claims. This is a good update to begin our recession discussion.
Yeah, this was, in our view, very noteworthy last week. Is weekly initial jobless claims jumped about 30,000 to a level of about 261,000. Mm-hmm. And, at face value, that doesn't seem like a lot, but going back to our rule, our signal we've established around initial jobless claims in terms of predicting recession, anytime initial jobless claims, take the 12-week moving average, anytime that jumps 20% from the low over the past year, so that's this orange line, mm-hmm. That's the warning shot. A recession follows every single time. Sometimes there are some head fakes, like we had back in 1990, that was a little bit of a head fake. And then in the late 70s, a little bit of a head fake. But that's the warning shot. And then once they're up 25% from the 52-week low, that's it.
You're done.
Every time.
Every single time.
And so, why is 261,000 noteworthy? Because on an absolute level, that's not a lot. If we get 261,000 again this week, we'll be at 20%. If we get 261,000 every week from now until July 10th, we'll be at 25%.
That's only 4 weeks.
Right?
Yeah.
So you're talking about, the yield curve mm-hmm. has been signaling recession, and that sort of signal is active. The real economy, just ask the conference board, it's been signaling recession. That mm-hmm. signal's active. The labor market and financial markets, things like the S&P 500 equity prices, those are the only two things not signaling recession right now. And the labor market is very close to signaling recession, which I know we're going to get emails and questions about what are we talking about. It's true.
Yeah.
This is always how it happens. It's like a stealth softening of the labor market, and then all of a sudden everybody knows about it, right?
Yep.
So that's very close to signaling. And then the last piece would be, market stress once that signals. And that would, once labor market signal, if that activates, then the market stress will follow.
Yeah.
And the liquidity picture is saying that there should be more stress than there is
right.
in markets. So it could happen very quickly, all sort of come together.
It usually happens that way. You're not expecting it, and then it happens quickly. So this is, we said March was going to be a key month, which I think it was, but I think back half of June, July is going to be super interesting to see how everything plays itself out. In terms of updates to the recession, any big changes overall?
Yeah, so no big differences here in probabilities. That labor market signal, it's a binary, yes or no. It's still technically below 20, so It's a no. So, we're probably closer than these numbers are implying, and that's a big reason why we've been spending a lot of time and effort rethinking about our recession forecast and probabilities, and can we make this timelier, more useful, turning things into signals. And this doesn't mean a lot right now to the viewers as I'm saying it, but basically, we're going to have some exciting stuff that we're going to be sharing pretty soon here around that.
Yeah, great. All right, well, I think that'll do it for the week. Appreciate everyone joining. If you have any questions, as always, reach out to us or contact someone on the private wealth team. Till then, we'll see you next week.